Bay Street and Wall Street are doing earnings forecasts based on gold prices that are $1,000 below market.
Okay.
How can you not be surprised if there's an extra $1,000 an ounce in margin? I mean, this is truly silly.
Yeah.
Now, I think when I talk to the institutional investors, they aren't paying an awful lot of attention to Wall Street or Bay Street forecasts, which I think is sensible. But when you look at consensus estimates around, as an example, Agnico Eagle, I think the analyst consensus is $3,250 an ounce. And as you point out, Agnico's selling the stuff for over $4,000 an ounce. How do you not have an earnings surprise? One of the most repeatable topics around a gold bull market has been that when the generalist investor begins to come into the precious metal space, that leadership changes from gold to silver. It would appear, Steve, that that's occurred. The silver price is greatly outpacing the gold price. You need to look at that chart and see if the silver market doesn't need a rest. It looks to me like the silver market does need a rest. Now, I'm not a silver buyer. I'm a gold buyer. But I am a silver stock buyer. And that chart gives me a lot of caution.
Rick Rule says we are in a real precious metals bull market. But most investors still haven't entered. Gold miners are being valued using prices nearly $1,000 below reality, setting up major earnings surprises. Silver may need a short-term pause after going parabolic, but long-term fundamentals remain strong because most supply is a byproduct of declining base metal mining. Thanks for watching. Subscribe to Find Metal for more updates.
I would say fervor in the streets. I mean, understand that I'm not a trader per se. I construct very, very, very rough models around value. So price matters to me only as it differs from value. And the silver stocks that I had owned as a consequence of my belief in a move in the silver price, I have already sold. My reason to own the stock came and passed, and so I sold the stock. Well, one of the things I guess two overriding comments. We are, of course, really, truly in a precious metals bull market. But I would suggest to you that we are not yet in an industrial materials bull market. The interest I found, especially in London, which has been a center of oil and gas finance for 40 years, was muted enthusiasm at best for oil and gas, enthusiasm for gold to be sure. But even around precious metals, what you see is that the generalist investor, while starting to be interested, is not really in the space yet, which suggests that there is some room to run. Conversely, among the people who are in the space, interest is at a fever pitch. It's odd that, as an example, at one of the great retail conferences that takes place, the New Orleans Investment Conference, the audience is more interested in the opportunities available to them after a 60 or 70% price rise than they were before, evidenced by the European, in particular the German retail and the Swiss institutional investor. The two conferences that I spoke at in Switzerland and the one that I spoke at in Germany, particularly the Swiss conferences, I was very impressed by the sophistication of the private family offices in Zurich and some of the financial fiduciaries in Zurich. I guess I shouldn't be surprised that the Swiss know something about gold, but it was heartening to see the level of sophistication that was present at that conference. And finally, in London, despite the idiocy of the British government, the total idiocy of that government, you are reminded once again that London is a real center of mining investment, and for that matter, oil and gas investment. And what always strikes me when I go to London is the sort of 200 years of experience that they have investing outside Great Britain. Possibly the reason they invest so much outside Great Britain is because their government is even more efficient than ours at making their country a lousy place to invest, and they have to. But the lack of ethnocentricity among the British investor, their willingness to, and their knowledge of locales as disparate as Congo and Kazakhstan and Chile is very refreshing. Often American institutional investors think that Alabama is an exotic location, and the Brits are substantially more understanding of global investing than we see in our own country. So, I came back with a variety of things. By the way, I need to say, each individual event I spoke at was a great opportunity in and of itself.
And alarm bells in my head can't help but be going off. Is that misplaced, or am I accurate?
I think it is misplaced, Steve.
Okay.
Because only about 18% of silver supply comes from silver mines. The rest comes from recycling or as a byproduct of mining other materials like gold, copper, lead, and zinc. So to really get a feeling for what silver production looks like over the next 5 years, you have to pay attention to how much copper is going to get mined. And I think irrespective of what we do in the copper industry, we're going to have production declines in copper for the next 5 years, no matter what we do.
Yeah.
Which means that byproduct silver production is going to decline. Remember that as a copper miner, your production cost is effectively the cost of removing silver from the product stream. You have no mining cost because you paid for that in the gold account. The zinc price has been up, but it's still fairly flat. And I don't see any production increases coming in copper or lead or zinc for the next 5 years. In copper, I think it's more likely that we produce less over 5 years rather than more. And that should mean that byproduct silver supplies are lower. When I look too at the silver mines on the horizon that could be brought into production, I don't see many. Certainly the exploration success that, as an example, First Majestic has enjoyed both downhole at San Dimas, but also at Ermitaño. And the prospective joy that Pan American sees at La Colorado, you don't see a new Cannington or a new Juanicipio. You don't see that much silver on the horizon. The two places that you do see silver on the horizon, one would be the Pan American deposit in Guatemala, the name of which escapes me, which appears to have still pretty strong political challenges ahead of it. The second would be another silver deposit within Pan American in Argentina, which is similarly, at least at the state level, politically challenged. So I don't see a lot of impending supply from silver companies. And I don't see near-term supply increases from byproduct. That is to say, increases in the next 5 years.
Okay. Because most of silver comes from copper mines.
Comes as a byproduct. Copper, lead, zinc, and gold. You are going to see some production increases on the gold side, which should give you some increased byproduct silver. But I would suspect not enough to be worried about. I understand your concern perfectly around the incredible margins in the silver business, where the silver industry would increase their production if they could. I just don't see them being able to in the near term. And it's important to recognize, as I say, that less than 20% of primary silver supply comes from silver mines. The intention of silver miners is less important than the intention of recyclers, who are pretty close to maxed out. And gold, copper, lead, and zinc producers. I believe that there are circumstances individual to each company that will increase their value. So as an example, I own Pan American Silver. The increase that we've seen in the silver price makes their acquisition of mag silver more economic than it would have appeared at the time that they made the acquisition. That was an acquisition that was predicated on $35 silver.
Yeah.
$60 silver rewards them more than $35 silver did. In Pan American Silver, I'm also attracted to it because they have now had, 5 or 6 quarters to begin to work their magic on the assets that they acquired from Yamana. And sure enough, they're beginning to get better operational performance at the same time that they're getting higher commodity prices. One could look at my holdings in the more speculative names, Vizsla Silver or Abra Silver. In both cases, I think that there is a lot of exploration upside uh, in the company. In other words, I don't own them purely for leverage to silver. I own them for reasons interior, if you will, to the company. Ironically, in a rip-roaring silver market, there's probably more money to be made on the bullshit juniors that don't actually have silver or the very, very, very inefficient producers. Because as sentiment comes into that market, you can take up a $20 million market cap to a $100 million market cap for no fundamental more specific than a $500,000 financial public relations budget. That's not the way I trade. I'm very much a guy who invests, who buys and sells based on value or perceived value. And there's a lot of value and perceived value remaining in the high quality silver names, despite that parabolic silver chart. The thing that makes me both bullish and bearish, depending on the time frame, is the lack of price response that you've got in copper relative to the fact that there is a supply deficit, a structural deficit in the market now.
Yeah.
And that deficit gets larger no matter what we do over 5 years. And more importantly, the fact that fully 7% of the world's ongoing supply is currently offline as a consequence of the shutdown of Kakula, Grasberg, and Cobre Panama. You have a market that was already structurally in deficit where 7% of global supplies come offline, and the copper price isn't up that much. One would expect, as a consequence of those offlines, for the copper price to be up more like 20 or 25%. What I suspect you're seeing, Steve, when I look at the muted response in the physical copper market, and I look at the very muted response in the oil and gas markets, is that the global economy is much weaker than we think it is right now, and that current demand for spot market supplies of industrial materials is weak because global demand is weaker than we believe it to be. If that's true, in the very near term, we could experience price softness or even price weakness. It tells me that if the economy recovers, that there are gaps up that we can expect.
Okay.
And I suspect the difference between the two is a function of time. If you have a 1-year time frame on your investments, you need to be very, very cautious, I think. If you have a 2 to 5 year time frame, or better yet, a 3 to 5 year time frame on your industrial materials investments, I think there's a lot of money to be made.
Have you heard of any resolutions that are coming out with Cobre Panama, with Grasberg, with any of these?
Believe me, I've been looking at all of them.
Okay.
And the answer so far is no, no, and no. There's a lot of interest around the niche metals, which is probably dangerous.
Okay.
Dangerous in the sense that, it takes one new vanadium discovery to obliterate the vanadium market.
Vanadium's back. Okay.
As an example, there's a lot of interest around rare earths.
Okay.
And not very much knowledge. I actually heard a couple of speakers around rare earths who were amazingly unknowledgeable. They knew so little they didn't even know that they were unknowledgeable. They just knew that the topic would gather attention. There is genuine interest around the copper space, but I suspect that some of the interest is tenuous enough that if the copper price doesn't take off in the near term, that the people who are expressing that interest won't have the intestinal fortitude to stay a trade that'll make them a lot of money over 5 years. Okay. The other thing that impressed me, and I guess I should know this from our own efforts at Rural Investment Media in the Rural Classroom, is how much cash is on the sideline. While I suggest that we have solvency problems collectively in the United States, boy, is there a lot of liquidity. Liquidity and solvency are very different topics, but there is an incredible amount of liquidity waiting to come into this or some other market.
Okay. So you saw a little bit of caution around some of the niche metals like rare earths that seem to
I wouldn't
spike
say
up.
caution. No, I would say differently. I think there was more interest in there, perhaps, that is warranted there relative to either the oil and gas or the copper market. I still see a market that seems to be driven more by style and story than substance. Perhaps it's precisely because people aren't familiar with these topics and don't understand the risk that they're attracted to the narrative. That was troubling to me.
Okay. Okay.
The
All right.
the interest that people had in substances they couldn't pronounce was in fact a little troubling to me.
Okay. All right. So you're saying they may be a little too excited about something that they don't understand.
Correct.
Macro thoughts on oil? What? Let's get your macro thoughts first, and then I'll go into something else.
The most important macro thought on the supply side is underinvestment in sustaining capital of between $1 and $2 billion a day. Producers around the world are not investing enough money in the oil production to maintain production 2 or 3 years out. At $60 oil, and we're not at 60, we're below that, the United States has drilled through apparently 85% of its tier 1 drilling locations using current technology. So at this oil price, I think it's fair to say that U.S. production has plateaued. And it was the U.S. that was the difference between supply and demand. The Saudis have done a very good job of maintaining sustaining capital investments. And it would appear now that the Saudis have between 800,000 and 1 million barrels of surplus producing capacity, which they could increase. But you have structural declines in Mexico and Venezuela in particular, where declining sustaining capital investments have reduced their ability to produce. You also have what would appear to be systemic production declines in the British part of the North Sea sector, again, politically induced. The wild card, of course, would be any peace announcement in Ukraine. If the Russians were permitted back into Western markets, while it might not impact oil markets immediately because the Russians have deferred sustaining capital investments too, they will be slower to ramp up than people think. It would immediately impact European natural gas markets. The ability of Russian natural gas to back out some LNG that's currently being shipped into European markets would impact global markets. But I suspect the real story that you're seeing in that price deterioration has much less to do with supply and much more to do with weakened demand. Weakened demand, particularly in growth markets, or what were growth markets, and in continental Europe, where I think the economy is much weaker than people think it is. That chart tells me that you are seeing demand hiatus in continental Europe, and you're also seeing demand hiatus in China.